In this video, I'm going to explain accounts receivable as in Activity 58. I'll first give a brief explanation about what accounts receivable is, and that will be followed by, then you do this activity here, Activity 58, and then I'll go over the answer with you. Accounts receivable occurs when companies extend credit to customers. So the definition of an accounts receivable, a good working definition is money owed to a business by its customers for sales made. So typically what will happen is companies make sales to customers and it takes a while to collect the money. It's not like when you buy something in the store and you're expected to pay for it immediately. If a company ships a truck full of goods to a customer, then it might take a while for the customer to pay them back because they have to get all the paperwork together. There's various different papers to do, and information about the shipment has to reach the accounting office so that they can sign and mail a check. Accounts receivable is an asset and it goes on the balance sheet because the company does expect to collect almost all of the money. Now, what allowance for bad debts is, allowance for bad debts is money that a company expects not to collect. So it's the balance of accounts receivable that a company expects not to collect. And this would just be an estimate. The company has to look at all of its accounts receivable and say approximately how much aren't we going to collect? And this would be something called a contra asset. And it's a negative asset. And it would be subtracted from accounts receivable to arrive at accounts receivable net. And that's the number that actually appears on the balance sheet. I shouldn't say this is on the balance sheet. It gets added in, just like the contra asset gets subtracted. So accounts receivable net, accounts receivable minus the allowance would be accounts receivable net, i.e. this is the money owed to a business by its customers for sales made that it expects to collect. And again, this is an asset on the balance sheet. This is the number that will actually appear there. So the relationship between these three numbers is, let's say you had $1 million in asset in accounts receivable, and the company makes a determination that $20,000 of this it's not going to collect. Then accounts receivable net would be $1 million minus $20,000 equals $980,000. That would be accounts receivable net. So if we look here on Apple's balance sheet, this is Apple, September 26, 2015. One of the items is accounts receivable less the allowance of 82 would be 16,849, and this is in millions, so this is really $16,849,000,000 owed to Apple by its customers. Who are Apple's customers that would owe it money? It's most likely going to be stores that carry Apple products and cell phone companies that also could sell Apple products like iPhones and stuff. So collectively, these companies owe Apple $16,849,000,000 and expects not to collect 82. So they actually owe a little more, $82 million, that's not included here. The next thing is bad debt expense. Bad debt expense is the portion of sales revenue that a company expects not to collect. Now notice the difference here from allowance for bad debts. The allowance is the accounts receivable that a company expects not to collect. Bad debt expense is the portion of sales revenue that a company expects not to collect. And this is most obviously an expense that's going to appear on the income statement. Now the way bad debt expense works is that at the end of a period, a company is going to make an estimate of what its bad debt expense will be. And when it records it, the recording, I'll write it here, the recording of bad debt expense also increases allowance for bad debts. So when you record bad debt expense, then not only is bad debt expense going to go up, but also there'll be an increase in the allowance because now there's a larger portion of the accounts receivable that you expect not to collect. So let's say that a company determines that it has bad debt expense in this situation of $5,000. Then what would happen is that the allowance for bad debts would also increase by $5,000. So one would increase along with the other, and then the total accounts receivable net would also be decreased by $5,000. And the mechanics of how to do this, we haven't covered this yet, but we will be covering it by the end of the semester, of exactly how you would record bad debt expense. One more thing to know about is what we call write-offs. The way write-offs work is when you determine that a bad debt goes bad, then you write it off. And what will happen is that write-offs reduce the allowance for bad debts and accounts receivable. So a write-off would reduce both this figure here, accounts receivable, and the allowance, each of them. So what would happen is, since one is subtracted from the other anyway, it wouldn't make a big difference. So let's say you had a write-off of $1,000. Then your new accounts receivable would be $999,000. I'm going to put this in another color, say red. Your allowance for bad debts, which we just adjusted to $25,000, would be reduced to $24,000. And accounts receivable net would be reduced. Then $999 minus $24,000. Accounts receivable net would still be $975,000 because $999 minus 24 is also equal to $975. So accounts receivable net would stay the same. Write-offs don't affect accounts receivable net. It's very important. And they don't affect the expenses directly. All they do is they reduce the allowance for bad debts and accounts receivable. The reduction in income happens when you record bad debt expense. The next thing to do now is to go over activity 58. Try it out, see how you do, pause the video, try it out, and then watch the video to go over your answer. Okay, you're done with activity 58. Let's go over it. The allowance for bad debts is the portion of accounts receivable that it's estimated is uncollectible, and it's reported on the balance sheet as a current asset and not one of these other things. Total amount the customers owe this particular company is $90,000, and of this amount, $4,000 is expected to be uncollectible, and therefore 90 minus 4 is $86,000 is expected to be collectible. As a result of this financial statement information, total assets would increase by $86,000 because that's the total amount that they actually expect to collect. Bad debt expense is a portion of sales revenue. The allowance is a portion of accounts receivable. Bad debt expense is a portion of sales revenue, estimated as uncollectible, and it's reported as an operating expense on the multi-step income statement. It's operating because it's part of your business. Above, sales revenue earned during year 5 totals, there you can see it, $800,000. And of that amount, $15,000 is uncollectible. Bad debt expense is an estimated amount calculated at the end of each period. Just as a matter of routine, it's done that way. And this is an application of what we call the matching principle. If you remember, the matching principle says expenses are matched to the revenues that they're associated with, because expenses are by definition costs that bring on revenues. So the way the process works again is that you recognize revenue when they're earned, and then you would determine what expenses were necessary in order to earn those revenues. So just like we record cost of goods sold when we sell the goods, sales revenue, we're also going to record bad debt expense in the period when we made the sales that we expect to go bad. Because part of making sales is having bad debt expense. That's just facts of life. The adjustments record bad debt expense changes. This is pretty interesting now. It's going to change both total assets and net income. Because what happens with total assets is, why? When you adjust bad debt expense, I get it right here, when you increase bad debt expense, you increase allowance for bad debts, and you increase, which lowers total assets, and you increase bad debt expense itself, which lowers net income. Finally, with write-offs, we use the method that we use is called the allowance method. That's why we have an allowance. And that's used to report uncollectible accounts. So with these amounts, let's say $2,000 owed by Ryan was written off as uncollectible. But what would happen is, after this write-off, accounts receivable was $90,000. That would go down by $2,000 to be $88,000. The allowance for bad debts would increase from $4,000 to $6,000. I'm sorry, would decrease by $2,000 and go down from $4,000 to $2,000. And the accounts receivable net then would be 88 minus 2,000, or $86,000. So the write-off of an uncollectible account doesn't change total assets. Total assets in this case is still $86,000 plus whatever else the company owns. It doesn't affect net income at all because I record my expense when I record the allowance. And therefore it affects neither. And just a little note, accounts receivable net is also referred to as net realizable value. Bad debt expense could be called doubtful account expense or uncollectible account expense. And non-operating revenues and expenses are also referred to as other gains and losses. Now, bad debt expense usually doesn't appear on the income statement. Here we have Apple's income statement, so I'll show you. It's usually part of selling general and administrative expenses, just one of many, a whole collection of expenses that's included in that figure.